Welcome to Selftax YouTube channel. If you're an expat, business owner, or landlord and you're not subscribed yet, this channel is for you. We break down tax rules, deadlines, and changes clearly and simply. Hit subscribe and stay compliant, without the stress. If you are self-employed or you earn rental income, 2026 could be the year your tax reporting changes completely. Making tax digital for income tax is no longer a distant plan. For many people, it starts from April 2026. But the real question is simple. Do you actually need to use it? In this video, I am going to explain who falls into MTD for income tax in 2026, how HMRC decides, what qualifying income means, and what you should do now if you think you may be affected. Making tax digital for income tax is HMRC's new system for reporting income from self-employment and property using digital records and compatible software. Instead of relying only on one self-assessment tax return at the end of the year, people within MTD will need to keep digital records, send quarterly updates through software, and then complete a final declaration to confirm your overall tax position. HMRC's current guidance says MTD for income tax requires digital records, quarterly updates, and a final tax return process through compatible software. From the 6th of April, 2026, making tax digital for income tax becomes mandatory for sole traders and landlords with qualifying income over £50,000. This is the first group entering further to over £20,000. Now here's the key point. These thresholds are based on your total income from self-employment and property combined before expenses, not your profit. So even if you are not affected in 2026, you are very likely to be brought into MTD shortly after. This is where many people get confused. Qualifying income is not your salary from employment. It is not your total household income. And it is not only your profit after expenses. For MTD for income tax, HMRC looks at qualifying income from self-employment and property. So if you are a sole trader, HMRC looks at your reported self-employed income. If you are a landlord, HMRC looks at your property income. And if you have both, those amounts are considered together, gross income before expenses. HMRC's MTD for income tax guidance says the rules are based on qualifying income from self-employment and property, not employment income. Many people assume they need to calculate this entirely by themselves, but HMRC has said it will review submitted tax returns and identify taxpayers who need to join MTD for income tax based on the qualifying income rules. That said, waiting passively is a mistake. If your income is close to or above the threshold, you should already be reviewing your position, because by the time the start date arrives, you may need software, digital records, and a proper process in place. HMRC says it will use information from tax returns to identify who is required to join, but people who are likely to fall within the rules still need to prepare for compliance. Not everyone is in from the start. If your qualifying income is £50,000 or less, then the 2026 start date does not apply to you under the current threshold. Some people may also qualify for exemptions in certain situations, such as digital exclusion or other specific reasons accepted by HMRC. So the key point is this: being self-employed or being a landlord does not automatically mean you are in MTD from April 2026. The threshold and your circumstances matter. HMRC's current rules say the first mandatory group is those with qualifying income over £50,000, and exemptions can apply in limited situations, such as digital exclusion. If you are within MTD for income tax in 2026, you will need to do more than just file once a year. You will need to keep digital records. You will need to use compatible software. You will need to send quarterly updates. And you will need to complete the final declaration process through the software as well. That means this is not just a deadline change. It is a process change. HMRC states that taxpayers within MTD must keep digital records and use compatible software to send quarterly updates and complete the final declaration filing process. If you think you may fall within MTD for income tax in 2026, these are the practical steps to take now. First, check whether your qualifying income from self-employment and property is likely to be above £50,000. Second, review how you currently keep your records. If everything is still on paper or scattered between spreadsheets, emails, and bank statements, that is a warning sign. Third, look at MTD-compatible software options. Fourth, get used to the idea that tax reporting is becoming a regular process throughout the year, not just one annual task. HMRC provides guidance on compatible software and says taxpayers who are due to enter MTD from April 2026 should sign up and prepare. These are the biggest mistakes people are making right now. 1. Assuming MTD is still far away. 2. Confusing profit with qualifying income without checking HMRC's actual rules. 3. Thinking landlords are not included. 4. Assuming this only affects big businesses. And 5. Waiting until April 2026 before looking at software or record keeping. That approach will leave many people behind. The mandatory MTD rollout from April 2026 applies to sole traders and landlords above the threshold, not just large businesses. So, do you need to use MTD for income tax in 2026? If you are a sole trader or landlord with qualifying income over £50,000, the answer is yes, you are likely to need to use MTD. If not, you may still be affected later as the thresholds drop. Either way, this is the moment to check your numbers, understand the rules, and prepare early. Because the people who struggle most with tax changes are usually the ones who wait until the change has already arrived. Thanks for watching. Subscribe to Selftax for clear, practical UK tax guidance. Stay informed, stay compliant, and stay one step ahead of HMRC.